Let's look closely at the plans for YEIDA. The government is attempting to build a multi-engine economic region entirely from scratch, rather than simply expanding an existing residential suburb. If you've seen the marketing materials, you've probably heard the pitch. Buy land here today, and you're sitting on an immediate gold mine. But take a drive through Sector 22D right now, and you won't see a bustling city. You'll see mostly empty land. That is the reality of early investing. You aren't buying a functioning neighborhood. You are buying a blueprint. This map outlines the Yamuna Expressway Industrial Development Area Master Plan. When you zoom out and look at the color-coded zoning, you start to see why that long-term hype exists. The scale of the government layout is massive. The plan relies on several distinct economic engines to drive future demand. Notice the large blocks designated for the upcoming film city in Sector 21, the industrial zones around Sector 29, and the main Yamuna Expressway corridor running right through the middle. Here is where Sector 22D fits into the layout. The blue arrow points right to plot TS4 inside the Sector 22D boundary, placing it dead center within the planned ecosystem. It sits inside a dedicated residential belt, flanked by sectors like 22A and 19. Over time, these adjacent blocks are meant to form one large, continuous community. The core value of this specific plot is not how easy it is to access today. Its value is tied entirely to how it will eventually connect to the major interstate expressways currently under construction. Making a smart move in YEIDA means tuning out the current lack of population density. Your success here depends entirely on placing a bet on the government finishing that heavy infrastructure. The first major variable you need to weigh is what it actually means to buy into a strictly zoned master plan. Unlike older, organic cities, investors here enter a system where residential, industrial, and commercial districts are forcefully separated by law. This ensures a higher quality of life, preventing traffic bottlenecks and keeping industrial manufacturing completely isolated from residential areas. In fact, a significant portion of this layout is dedicated exclusively to wide green belts, parks, and recreational buffers. But there is a direct trade-off to this kind of regulation. Every square foot is pre-planned. You won't get those spontaneous, chaotic neighborhood hubs or the sudden pop-up of local corner shops that you find in naturally growing cities. Right now, the major infrastructure exists in isolation. You can see it at the Yamuna Expressway toll plaza, highly functional but surrounded by very low-density environments. As an investor or future resident, you are entirely reliant on the government's execution timeline before any local amenities appear. Buying into Sector 22D means giving up the convenience of immediate neighborhood growth. In exchange, you are buying the future guarantee of a meticulously planned, congestion-free environment. The second major metric to evaluate is the financial reality of an airport-led economy. Capital is actively going into the ground to make this a reality, starting with the structural progress of the Noida International Airport terminal. You are deploying capital into an infrastructure growth cycle. The eventual value hinges entirely on the completion of the airport, the nearby semiconductor hubs, and the international film city. When those facilities come online, they will require a massive workforce. We are talking about tech professionals, airline crew, logistics managers, and medical staff all needing places to live. That diverse job creation is what eventually drives high-value rental demand in the surrounding residential sectors. Look at mature airport ecosystems, like the commercial centers in AeroCity, to see the high-end standard expected once the ecosystem stabilizes. But here is the critical trade-off. During the years it takes to build these facilities and hire those workers, your property will yield absolutely zero immediate rental income. This chart maps opportunity cost. The axes track time against expected return. Mature markets sit in the lower left quadrant, short tenant wait times, but limited future appreciation. Sector 22D sits upper right, high expected return, but requiring a much longer wait. The early entry prices in YEIDA are significantly lower for one specific reason. The investor is taking on the financial burden of that waiting period. Securing a low price point today is only a mathematical advantage if you can afford the opportunity cost of holding illiquid capital during construction. Whether or not Sector 22D is the right move for you has very little to do with the dirt itself, and everything to do with your personal financial timeline. Let's filter this to a simple decision matrix based on your time horizon, under 4 years or a 10-plus year hold. If you're looking for a quick flip or need immediate rental income for a mortgage, follow the path on the left. You need to avoid this area. Minor infrastructure delays or macroeconomic fluctuations will severely penalize short-term holders. Your money will simply get stuck. Now let's look at the ideal candidate. This is the portfolio diversifier, someone who already owns yielding assets elsewhere and has stable cash flow. For this demographic, the goal is long-term land banking to capture future corporate rental yields. These investors are perfectly positioned. They can ride out the inevitable bumps and delays of the construction phase without facing financial distress. And the ultimate payoff for waiting is integration into a massive national transit and logistics network. Making a smart real estate investment isn't about chasing the loudest hype. It is about taking an honest look at a master plan's maturity cycle and strategically aligning it with your own financial reality.